Okay, so again, I've highlighted the conversation, and I've also highlighted the financial statements. So the highlights for the financial statements and the conversation coincide. I've highlighted the conversation pink for the information that you're going to be using on your project in the character section. So we're not going to need to use this information. I've highlighted green the information regarding your long-term assets. I highlighted purple changes regarding sales, which is useful for your working capital sections, because remember, sales and days on hand coincide. I highlighted blue the changes in the loans in your debt, and then I highlighted orange changes in your income statement on the operating expenses, and then I highlighted yellow changes in current assets, notable changes. So I highlighted all of it. This is where you're going to gather the information, and then this is also where you're going to gather the information that we're going to be stating here. So brief explanation on liquidity, right? We're going to start it off with an explanation on what our liquidity consists of. So the borrower's liquidity consists mainly of AR, which make up, and let's do the math real quick. AR is 980 divided by 1027, which make up 95% of liquidity, which make up 95% of total current assets, right? Now we're going to make a bullet right here. I don't like my spacing, it's too spaced. I like stuff more together. Okay, so the borrower's liquidity consists of AR, which make up 95% of total current assets. So when you're doing inventory, I want you to do the same thing, right? Find out how much of inventory makes up the total amount of current assets, and I want that to be your first statement. So for mine, we only have accounts receivable, so that's my first statement. But if I had accounts receivable and inventory, then I would do accounts receivable make up 95% and inventory makes up, let's say 4%, right? That's how I would say that. And if cash is a significant portion, which for me, as you see, it's not, if cash makes up more than 5%, then I would say cash makes up 5%, right? Because I want you to document all of the current assets that make up more than 5%. But for me, again, AR makes up majority of the total current assets. So that's the only statement I'm going to make. Down here, the first order of business, we're going to compare year to date to the industry. And actually, let me add as of year to date 2025, right? So we're gonna compare their year to date figures to the industry. So when we look at the industry standard, we're going to start off with current ratio. The borrower's liquidity ratios underperform compared to the industry. The industry median for current ratio is 2.00x as of, compared to the borrower's to the borrowers 0.60x. And I'm just going to copy this statement because I'm going to say the exact same thing over again. And the industry median for quick ratio, or let's say acid test ratio, is 1.50x compared to the borrower's 0.59. Okay. The borrower's liquidity position comes as a result of, and remember, their receivables did go up significantly. They went up from 600,000 to 1.2 million, and then it dropped down $300,000 to 980,000. But keep in mind, like that, they were still below the industry median here, right? That at 97.97. And the reason why it was so high then was because their accounts payable were really high, and then their deferred revenue were really high. But remember, they paid down their deferred revenue $300,000, and then they paid down their accounts payable $400,000. So if they paid down their short-term liabilities, the only reason that this current ratio and quick ratio won't have gone up is if they incurred another liability. And in this scenario, in this case, it's the loans from related. So their loans from related increased by $1 million in 2025. So if we remove, or let's make this statement first. The borrower's liquidity position comes, the borrower's liquidity position is a result of the borrower's liquidity position is a result of increased loans from related companies of $1 million. If removed, current ratio would be, so if we take out $1.2 million, right? We can run this real quick. We take out 1.2 mil, or 1 million. We're gonna do 45 plus 980 plus 2, right? 1027 divided by 721. And the way I got that, I just took I subtracted 1,723 by 1,002 equals 1.42. And you might be wondering, like, Makai, what made you think of doing that? How'd you come up with that? Why are you doing that and I can't? Well, the thing is that when you read the conversation, they'll bring up some of the things. So in this conversation, he says, hey, your debt increases a lot. He says it in the blue. Every blue sentence he's mentioning this debt. So hey, you increased by $1 million loans from related companies. Can you explain that? He says, yeah, we bought new machinery, and we're paying 9% on that every single year, principal and interest. And then Eddie suggests, hey, why don't you subordinate that to us? And he agrees and says, oh, I figured that would come up. We'll allow the subordination, right? He'll allow it. He wants to subordinate it. And Eddie says, yeah, we'll allow you to get interest on that, but while it's subordinated to us, it's under our discretion. So the reason why I'm adding that back in is because they're subordinating it to us. And I'll explain how subordination works once I finish making the statement. Quick ratio would be, let's open that back up. We're going to do 1027 minus 2 and I'm taking out the 2 because non-operating current assets. Quick ratio is cash, marketable securities, and accounts receivable. Nothing else. That's all. Cash, marketable securities, and accounts receivable. That's how you calculate quick ratio. So that's going to be in the numerator divided by 721, 1.42. Ratio would be 1.42x, just below industry median, which is just below the industry median, right? Okay, so now to explain how subordinated debt works. So subordinated debt means that if you take out a $1 million loan, you can't repay them until I'm fully repaid or I decide that they can be repaid. Subordination means that the terms of your loan are not going to be recognized until I receive my money back first. So it's basically, let's say there's me, you, and Boo Boo, right? And Boo Boo gives you $1 million. He's a fool. He gives you $1 million, right? Boo Boo gives you $1 million, and now your plan is to buy something that costs $2 million. Equipment costs $2 million, right? Now you come to me, Makai, and you want to borrow another $1 million. Now I say the only way I'll give you $1 million is if I get to be repaid first, right? I get to be repaid first. First payment. So that means until this $1 million goes down to $0, Boo Boo the Fool is going to have an outstanding loan of $1 million. They will not be repaid back until my loan is paid in full. So as long as my loan is outstanding, as long as I have any amount of this outstanding, they will not receive any principal payments. Now, the terms of this subordination agreement are that they will continue to receive interest payments. Yes, we will allow them to receive interest. So he can get 9% of this in interest every single year. But remember, when it comes to interest is 9%, right? So let's do 9%, 0.09 times 1. So they can get paid $90,000 in interest every single year, right? But what they cannot do is have their principal repaid. So this principal will never go down to 900,000. It will never go down to 400,000. It will never go down to 600,000 until I get my entire $1 million back. That's what it means to subordinate a loan. And the reason why I'm changing things up as far as how we calculate things is because if they can't repay, if they can't repay that loan, then while it is debt, in-house, internally, when I'm having my analysts run an analysis, I want my analysts to treat subordinated debt as if it's preferred stock. Preferred stock is equity where you guarantee an interest payment every single year as opposed to common stock, where common stock is not guaranteed interest payments every single year. So common stock is not guaranteed distributions. Preferred stock is guaranteed distributions. So anyways, essentially what we're doing when we subordinate their debt to us is we're converting their debt into preferred stock, right? And again, the reason why their stock changed, or the reason they took out the $1 million loan was so that they could buy new equipment, right? Jonathan Verde, he says the loan was for new equipment. We invested in a machine that applies a coat to the wheat products, increasing the shelf life an extra month. That upgrade was necessary for us to finalize the deal with Sprouts. We are currently paying 9%. So we're going to go back to this statement when we analyze leverage, and we're going to go back to that statement when we analyze income statements, the income statement analysis. So there's going to be 2 times when we have to reference that information, and it's going to be here and it's going to be here. So anyways, this is a fairly decent analysis of the current assets, the state of the current assets right now, right? And we can add one more statement. We can talk about how they increased or decreased, but we don't necessarily have to. Basically, what you can take away from this is that current assets went down, right? They're underperforming compared to the industry. So what we're going to do is we're going to save this. We can leave that now. We're going to save this. We're going to close that out. And now we're going to go and reference policy. Right? What does policy have to say? So we have our credit risk. We have leverage, collateral, debt service coverage ratio. Okay. We'll probably have to reference the leverage. Okay. Inadequate liquidity, right? Inadequate liquidity. These are credit risks. So this, we're going to have to reference this, right? Let's see. Collateral shortfall. Sales decline. Okay. So we're going to have to reference that for sure. That's one thing. Now let's go down. Okay, capital. Subsection 1, balance sheet. Liquidity. Liquidity that deviates from industry standard by more than 25% must be mitigated. Okay, so how much does it deviate from the industry standard? By industry standard, we mean the industry median. So that's going to be 2.00 minus 0.25, right? So in order to be within the industry standard, then it's going to have to, their current ratio is going to have to be 1.75. And their quick ratio is going to have to be 1.25. So they exceed the requirement, or our policy. They exceed our policy for the quick ratio, but they don't exceed our policy for the current ratio. Okay. Liquidity that deviates from industry standard more than 0.25 must be mitigated. Okay. Good. So what I want y'all to do is, I want you, once you finish that, I want you to come into the thing and then run this equation and see if yours deviates by that much. Okay. Let's keep going. Let's see if there might be something else that we're missing. Okay, we're good so far. So, liquidity. So we're gonna go to the top, and in our risk section, and we're not gonna go in and mitigate it yet. And we already have 2 risks from different videos that you guys haven't watched yet. We're gonna add a risk. So risk, liquidity. The borrower's liquidity falls below industry standards for falls below a 0.25x deviation from industry median, right? Right. And let's not say liquidity ratios, that's my bad. Liquidity ratios falls, the borrower's liquidity ratios fall below a 0.25 deviation from industry median. Okay, that sounds right. That makes sense. And then let's go up and let's see if that's also something up here. Inadequate liquidity. First to the borrower whose liquidity ratio is below that of the industry median. Okay, good. So this is supposed to be inadequate liquidity. That is the policy exception or the credit risk, right? That's our credit risk. And we're going to cite that. I'm going to highlight it yellow, 0.025, so that we don't forget that we have to go and reference that again, right? And we're going to be able to mitigate this, right? Those fell below. Cool. And we're going to be able to mitigate this eventually. You might be wondering, like, hey, Makai, how'd you know how to go and do that? Like, what made you know to go and check policy? Well, one, I don't expect you guys to come up with this stuff on your own. I don't think that you're going to know when a company's liquidity is bad. So because you guys are still learning, I'm just going to let you know how you can get into habits of recognizing when it's bad. This is a habit that I want you to form. I want you to get into the habit of checking to see if a company's liquidity ratios deviate by more than 0.25x. And if it does, then it violates the policies that I've written for you guys. And then I want you to come up with ways on how we can get comfortable with the increased risk that comes with them falling short of our requirements. So again, when you go into our policy, we have policies for leverage, we have policies for liquidity, we have policies for debt service coverage ratio, which we're going to get into later in the semester. We have policies for AR concentrations, which we'll get into later. EBITDA margin sensitivity, sales sensitivity, interest sensitivity, which we'll get into later. Evergreen lines of credit. And an evergreen line of credit is when a customer doesn't repay their loan over the duration of the time that they've had the loan. And I don't think that this company does it, but we could look. Let's say this was 224, right? And it was 224 in every single year. That means it's evergreen. That means they don't pay down their line of credit. They're just in a perpetual state of borrowing from us. And we don't like that. So anyway, evergreen line of credit. Collateral shortfall, that's when you don't have enough collateral to cover this. And this company that I'm working on, they do have a collateral shortfall. Consecutive sales decline. So if they have consecutive sales declines, they lose money in 2 periods, consecutive net losses, excessive distributions. These are all risks. And when you open the policies, section 0 is the credit risks. Section 0 tells you where all the credit risks are. These are the things that I want you to look out for. So again, what you're going to do is you're going to check to see if they fall below by more than 0.25, which they do. They fall significantly below it. And then we're going to have to go into the section titled Key Risks, which is the page after your structure page. You're going to go to Key Risks. You're going to go to Risk 1 or Risk 2 or whichever risk you have cited. And you're going to type inadequate liquidity. The borrower's liquidity ratios fell below 0.25 deviation from industry median, just like that. And we're gonna mitigate these risks at the end once we wrap it all up. Once we come here to write the analysis review, then we're gonna wrap it all up and we're gonna make that make sense. But for now, I just want you to cite that you noticed that this is an issue. Okay. And when you have a chance, I would read through the Texas Southern Capital Bank loan policy. It's a pretty decent document, and it gives you guidelines on how to underwrite and things to look out for when you're judging a company. So, anyways, that's how I want you to complete your liquidity homework, guys. And good luck. And yeah, let's do it. Good job. All right.